Hello everyone, welcome to another options video. This will be part 2 in the series where we'll now talk about the basics of options along with going through examples of the two types being puts and calls. So let's get started. An option is known as a derivative, meaning that its value is derived from an underlying asset. In this case, we will be talking about equity options contracts, so the underlying asset will be, for example, a stock price. So with options, an option is similar to a stock in the sense that they both have exposure to the company, but unlike a stock, an option has an expiration date. And also, one options contract consists of 100 shares. So if you wanted to, let's say, gain exposure to Apple, you could do so through buying Apple stock, or you could do so through buying an Apple options contract, most likely a call if you think the stock is going to go up, or put if you think the stock is going to go down. So that's sort of the difference there. The reason why options exist and have are viable is that with a stock, for example, if I wanted to have exposure to 100 shares of Apple, I could either buy 100 shares of Apple, which would cost me a little over 10 grand, or I can buy an options contract, which could cost as little as a few $100s. So you can see I'm putting up a lot less capital while still getting the same exposure. The risk obviously being that options do expire, so if they don't meet the certain criteria by a certain date, you can lose your entire investment. So let's get started here with the two types of options being calls and puts. A call gives the buyer of the call contract the right to buy the shares at a predetermined price at a predetermined date. Okay, so if you're bullish on a name, if an investor is bullish on a stock, he'll most likely buy a call options contract because a call's price will rise with the stock price rising as well. Now the opposite is for puts, where a put's value increases when the stock price decreases, because a put gives the owner of the contract the right to sell the shares at a predetermined price. So if you're bullish on a stock, you would buy a call, and if you're bearish, you would buy a put. So now let's go through what actually makes up an options contract. We talked about a predetermined price. This is known as the strike price or the exercise price, and that is the price at which the owner of the contract can convert that contract into shares. Or for a put, the price at which the owner of the put can sell the shares to the counterparty. So with the call contract, in this case, let's use Apple for example. Its current price is $113. This would be known as the spot price. The spot price is simply just the current price of the underlying asset. In this case, we'll talk about Apple. Apple's trading today for around $113. That'd be the spot price. Next, we have the strike price, again, which is what the owner of the call contract can convert into shares. And lastly, we have the expiration date, which is simply the date at which the options contract expires. So if you were shopping for a call contract, for example, it would be labeled something along the lines of November 15th, 120 call, Apple call. What that means is that the expiration date is November 15th. All right, this is the last day of which the contract, which the owner of the contract can convert it into shares. After that, the contract's over, it's worthless. The next was the 120. That's the strike price. That's the price at which the owner of the call contract can convert the contract into shares. And then lastly, it was the Apple and the call, Apple being the stock, call being the type of options contract. So let's say we have a November 15th, 120 Apple call. Apple's currently trading at 113. The option is said to be at the money because the investor, the owner of the call, why would he convert the contract and buy 100 shares of Apple for 120 when he could just he can go in the open market and buy the shares for 113? Therefore, the contract is out of the money. The strike price is below the spot price for calls. But let's say it's now November 14th and the option expires in one day and Apple is trading for 123. Well, the owner of the call contract can say, hey, I can execute this contract and buy 100 shares of Apple for 120 and then sell them immediately in the open market if I wanted to for 123, gaining $3 per share. Every option is 100 shares. That person just gained $300, ignoring the cost of the options contract. That option is said to be in the money. And if the strike price equals the spot price, the option is said to be at the money. Now let's look at puts, because puts can be a little bit more confusing. The put gives the owner of the options contract the right to sell the shares at a certain price. So let's go back to our Apple example, where currently today it's trading for 113. Let's say someone who bought a November 15th 110 Apple put contract. Well, currently that contract would be out of the money, because why would the owner of the put contract sell the shares to the counterparty at 110 when he could sell them in the open market? He or she can sell them in the open market for 113, right? But now let's say it's November 15th, the date of expiration, and Apple's trading for $100. Well, now the owner of the put contract can say, hey, look, I can convert my contract. I can sell my 100 shares through this contract at 110, and then if I want to, I can buy them in the open market for 100. I'm getting $10 per share. Options as 100 shares. The person just profited or gained $1,000 net, the premium being the cost of the options contract. So with a call, we want the spot price to be above the strike price, okay? Because the strike price is the price at which we can buy the shares. So if we can buy them for cheaper than what we can in the market, we're going to profit. For the put, it's the opposite. We want the strike price to be higher than the spot price, because we want to be able to sell or convert or sell our 100 shares through the options contract at a higher price, and then we can always rebuy them in the open market for a lower price. Okay, so that's basically how a call works. That's basically how a put works. And again, so we talked about the spot price being the current price of the underlying asset. We talked about the strike price, again, which is the price at which the option gets executed at. So if it's a call, it's the price at which you're buying the shares. If it's a put, it's the price at which you're selling the shares. And lastly, we talked about timed expiration. Now, very briefly, I'll talk about, and this will be a good segue into next video, what determines an options value. Now, an options pricing model, there's several out there. It's one common one is the Black-Scholes. That's very complex. We won't talk much about that at all. But an options value, it has two main components. It has its intrinsic value, and that's simply, best way to look at it is at expiration. What's the difference between the spot price and the strike price? Okay, so let's go back to our call example. Apple's currently trading at 120. Let's say we have a 110 call on Apple. That means we can buy the shares for 110, sell them for 120. We profit $10 per share. We profit $1,000. That's the intrinsic value of the option, right? That's the pure gain on the option. But also we have to take into account time to maturity, right? If we still have a month left until that option expires, there's value in that, because within that month, the option can become more in the money or go from out of the money to in the money. Things can change. And so the time value is the second component. The further out you buy an option, the more expensive it's going to be. So those are the two kind of components of options pricing you want to take into account. One, the intrinsic value, the relation between the spot price and the strike price, and two being how much time's left till it expires. So in the next video, we'll talk about what's called the Greeks, or sort of the inputs and variables that we will be looking at that sort of determine basically how will you make money as the stock price changes, right? How will the options price change when the underlying stock price changes? And so these are very important inputs and variables to look at when looking at buying options, to see how will you make money and what happens if the stock goes up or down and so forth. So we'll talk about that in the next video. I apologize, there's a lot to cover in options. It's a very complex subject. So these will not be under 5 minutes like I might have said before, but I really appreciate any feedback you guys have. Leave comments or questions below. I'll be happy to answer them, and I'll see you very soon. All right, see you guys.